Hello, and welcome to our conversation on financial statements. The focus of today's conversation is on the Pine Labs IPO. And in this presentation, we will examine some numbers and the narratives given in the RHP. Pine Lab Limited, Private Limited, was started in 1998 and become a public limited company in 2025. It was incorporated as a leading Indian merchant commerce platform that provides point of sale solutions, payment processings, and merchant financing. PineLab empowers businesses of all sizes, from small to large enterprises, with digital payment technologies and value-added services. It evolved from just a card-based payment solution provider to a comprehensive fintech platform. The company's key offerings, Smart POS, accept multiple forms of payments, including credit and debit cards, UPI, mobile wallets, and EMIs. Buy now and pay later offers instant EMI solutions at the point of sale for various consumer goods. Merchant financing, it provides short-term working capital loans to merchants through partnership with various financial institutions. Loyalty and gift solutions, it enables brands to offer loyalty programs, digital gift cards, and promotional campaigns. E-commerce and online payment tools offers APIs and payment gateways to support digital stores and apps. So it covers the entire value chain of any fintech company. The promoters and investors, the companies draft the red herring prospectus says that the company does not have an identifiable promoter, and it is a professionally managed without a defined promoter group. Some of the important shareholders who have more than 5% stake in the company are Peak Partners Pine Investment Holdings. Um, the investments are by PayPal. Investments are by MasterCard Asia Pacific Limited. The IPO date is it's open on 7 November and will close on 11 November. And there is a tentative date has been given for allotment as 12th November. What is the offer? The offer is 176 million shares, out of which the offer for sale is 82 million shares, where some of the investors are offering their shares for sale in the market. At the same time, there is a fresh issue of 94 million shares. The value of that in the range of 221, the offer value is 3,899 crores, out of which fresh issue is 2,080 crores and offer for sale is 1,819 crore. So this is the money which goes to the company, and this is the money which goes to the shareholders or existing investors. Before the offer, the number of shares of the company are 1,054 million. Now, with the fresh issue of 94 million, the post issue, the number of shares will go up from 1,054 million to 1,148 million shares. The objective of this IPO, besides the divestment of shares by the existing shareholders, is to repay or do some prepayment in part or full of certain borrowings. They're also going to invest certain money in their subsidiaries, make investment in the capex in the form of IT infrastructure and some general corporate expenses. So IPO money will be used for reduction of liabilities to some extent and creation of assets to a large extent. Now, the tentative price, the book building exercise, the band was given as 210 to 221, which is about 10.9 times to the existing revenue, which is comparable to the price multiples of Paytm. Though the price of Paytm was in the range was around 2,150, but the price multiple is more or less same, 10.9 to 10.7. Whereas other small issues, the price band was 3.6. For Policy Bazaar, it was 17.2. So Pine Lab has positioned near to the Paytm. Pine Lab wants a market cap of 25,000 crore, and that is slightly lower than the private valuation of 5 billion. At present, the market cap will be 2.9 billion, which will be lower than the private valuation. So, which we have already seen that is about 11 times of the existing revenue. And this is in line with the near to its competitor is a Paytm, which is still continuing to make incur losses. Despite this valuation, the promoters or the investors are going to make a reasonable amount of return on their divestment. We can see that there are most of the investors who are offering their shares for sale will be earning a very high rate of return, with an exception of AIM investment funds, which is making a loss of 9%. And there's also an exceptionally high rate of return by Lokvir Kapoor, who will be 45,000% because the average cost price of the shares was less than 50 paisa. Whereas the average cost per share by most of these investors are in the range of 10 to 250. So we can see that most of the investors who are offering their shares are going to are expected to earn a high rate of return because of this offer for sale. Now let us see the numbers to understand the financial performance of the company. The revenue of the company, as shown in the RHP, is increased from 15,000 million to 22,000 million from 2023 to 2025. So the revenues have been increasing over a period of time. But if you see the expenses have also increased from 19,000 million to 24,200 million. In the process, the company is actually making loss from 2,651 million in 2023 to 3,419 million in 2024, and 2025 the loss has come down to, but still a loss, 1,459 million. But the company has also shown quarterly results of the first quarter of 26. And we can see that the quarterly sales was 6,159 million in comparison to the Q1 results of 2025 at 5,224. The expenses were also high during this period. As a result, we can see that the company was profit before tax was in the range of 48 million, 4.8 crores. The corresponding loss in the last year, Q1 of 2025, was 24 crore. What is this expenses? The loss is PBT is negative because the expenses are high. What are these expenses? We can see that 44% of the expenses are toward the employee cost. So a large chunk of the cost is towards the employees' cost. The 11% accounts for the material. Depreciation is around 12%. Interest is about 3%. Now, therefore, the company's PBT in the latest quarter, adjusted also, is around 4.8 crore or 48 million, which is far below the PBT of the previous year's Q1. Whereas if you observe PAT, profit after tax, the profit after tax in 2026 Q1, June 2025 ending, is 48 million in comparison to 278 million loss in Q1 of 25. Obviously, question comes to our mind is why and how this happened. When PBT of the company is loss, how come there's a profit of 48.8? And this profit is created because of certain accounting adjustments. And all these accounting adjustments are also visible in the prospectus. And some of the important accounting adjustments are increase in other incomes, depreciation and impairment, and deferred taxes. So we can see that this profit is not because of operational efficiency, but because of certain accounting adjustments, which I call accounting efficiency. But is this profit creation is just for the sake of IPO, or was it a regular accounting adjustments of the company? Let us examine some of these accounting adjustments. Deferred tax. We can see that PBT, which was 48 million in Q1 of 26, have become profit after tax of 47 million positive. And this is largely because of the deferred tax. You can observe that this is a negative deferred tax. Current tax positive. Tax positive means reduction of profit. Deferred tax negative means it's an increase in profit. Let me elaborate that. This negative deferred tax happens, or deferred tax itself happens, when a company's accounting profit is not same as the tax profit. And the difference between accounting profit and the tax profit the tax on that is called the deferred tax. So the negative deferred tax happens when company reduces its deferred tax liability or increases its deferred tax assets. In the income statement, is shown up as a negative tax expense. It means instead of paying the tax by the company gains from the tax accounting. So this is purely an accounting adjustment. And this increases the profit after tax. So negative PBT has become positive PAT to a large extent because of the deferred tax. It's of course the PBT itself has reduced from negative 246 to negative 48. That may be because of depreciation and other adjustment. But the PBT becoming a negative PBT becoming a positive PAT is because of the deferred tax. And deferred tax is an accounting adjustment to address the difference between accounting profit and tax profit. Depreciation and impairment, there was a reduction in the impairment. In June 24, it was 12 million. It has gone down to 3 million. This is once again an accounting treatment as per Ind AS 16. Depreciation on property, plant, equipment has reduced from 420 to 391. Amortization on intangibles reduced from 234 to 196. So in the process, we are able to see that depreciation and impairment, which has no cash effect, but accounting adjustments have contributed to increase in the profit in June 20 Q1 26 in comparison to Q1 of 25. Similarly, there is also increase in other incomes. But this increase in other incomes has nothing to do with the operating activities of the company. These are, we can see that for this years, in June 24, the income from other sources 125 million, whereas the income from other sources have become 371 million. And a large chunk of this income is because of writing back of liabilities and provisions. So some of the liabilities have been written off or written down. As a result, profit has gone up. In the same way, there is a small amount of foreign exchange gains. So this writing back of liabilities and foreign exchange gains have contributed to the increase in other incomes. So increase in other incomes, decrease in depreciation, and the negative deferred tax have contributed to make the positive, the negative PBT as a positive PAT. So often people say that the companies indulge in this type of accounting jugglery before the IPOs. And there is a name given to this type of accounting called earnings management, managing profit by managing accounting assumptions. In the same way, after PAT, there is the total comprehensive income. The total comprehensive income in Q1 of 25 was negative 220, whereas in Q1 of 26 it's become positive 91. Again, the source is the prospectus. And The total comprehensive income is a PAT, which we already saw, plus other comprehensive incomes. And this other comprehensive income is because of the fair value changes in the equity instruments. So profit after tax, adjusted profit after tax, plus minus the OCIs, other comprehensive incomes and losses, gives us total comprehensive income. So increase in the total comprehensive income is also due to the accounting based adjustments. What is worrisome is the cash from operations. So profit has marginally increased, and the increase in the profit is due to accounting adjustments. But this negative profit and adjusted profit, along with a negative CFO, is definitely a worrisome factor. That means the company is not able to generate cash from its operations. And the negative cash from operations, as per their cash flow statement prepared as per Ind AS 7 and corresponding adjustments, has increased from 1,500 millions to 2,290 million in 24, marginally become profit positive of 497, but in the quarter, for the quarter, first quarter, it has again become negative 2,811 million. So negative CFO and negative PAT, negative PBT is definitely conveying a message that the company is not operationally doing well. At least financial profits are not there. However, the company has made an effort to show certain accounting profit by making certain accounting adjustments. Besides this profit, which are shown by the numbers given in the prospectus, the prospectus also explains in details, which are called narratives, in the form of risk factors. Several risk factors have been narrated, have been given in the prospectus, but here I've just picked up some of the important ones. The company says that we have incurred losses in the recent past, which we saw, including the fiscal year 2025, and the total expenses are 104% of the income. And they're saying that there can be no assurance that we will not continue to suffer losses in future. So it means there is every possibility that the profit may not be earned in the near future, and the company may continue to incur losses. We have already seen that the CFOs are negative, and there can be no assurance that the company will not continue to generate negative cash flows. And there is a concentration of revenue from a small number of customers. The top 10 customers accounts for around 30% of the revenues. And this revenue from operations is concentrated among few customers, and any decision by these customers to reduce or terminate their business with the company could significantly impact their business, financial conditions, and results of the operation. So concentration of customers is definitely a big risk. The company, because it is in fintech, is a highly regulated company. The company is subject to cybersecurity, data, privacy breaches, and that could interrupt their operations and adversely affect their reputation, brand, business, financial conditions. The company is also exposed to credit risk associated with providing instant and early settlement for their customer. This is a very important risk. Let us go to the prospectus and observe. Though this risk is associated with providing instant and early settlement, this is aimed at enhancing the experience of our customers by accelerating the funds flow and settlement process. This will require the company to pre-fund the relevant escrow account and pay the relevant merchants using their own funds and await for the payment from the counterparty, which is generally one day after the transactions. As a result, the company is required to ensure that day-end closing balance in the escrow account is not lower than the value of outstanding amounts due to the merchants. So so they have to maintain a significant amount of liquid cash to meet this type of, and any failure to comply this requirement could result in monetary fines, penalties, loss of licenses, and which may adversely affect the business, financial performance, and results of the operations. This is really an important risk the company is facing. There's a contingent liability of 3,300 million as of June 30th, 2025. If any of these contingent liabilities materialize, the financial conditions, the results of operations, and cash flow could adversely affect. Contingent liability means as of now they're not liabilities, but they're subject to, they may become liability on happening of some events. But what are these liabilities? Is an indirect tax matters. A significant part of contingent liability is indirect tax matters. Interest liabilities on these indirect taxes. So the total contingent liability out of 3,300, a big chunk is due to the statutory tax liabilities. And this contingent liability is around 14.2% of the equity of the company. Equity of the company stands at 23,000 million and the contingent liability is 3,300 million. So presence of contingent liability, which is equal to around 15% of equity. So this is another important risk as per the RHP. Receivables of the company are their inability to collect receivables and default in payment from the customers could adversely affect their business, financial conditions, and as a result, already the negative cash flow will also be affected. And we can see that for the last 6 years, the receivables have gone up from 214 million to 845 crores. The liability towards prepaid cards. This is another interesting, important, relevant risk factor in this type of fintech companies. What is this liabilities towards prepaid card? When a customer buys a prepaid card or gift card managed by a company like Pine Labs, money is received before the card is issued. And that money is not yet earned revenue. It's a liability because the company still owes that value to the cardholder or the merchants when the card is redeemed. So this will be shown in the liability side of the balance sheet. And we can see that the liabilities toward prepaid card has increased from 36,000 million to 47,700 million, which is about 45 to 44% of total equities and liabilities. So one of the significant part of the sources side of the balance sheet is the liability towards the prepaid cards. And a large balance here indicates a high volume of unredeemed gift cards, future obligations to honor these cards. Of course, this also can provide as a source of float for a temporary funds. So on this, the company has a very small commissions within the regulatory provisions. But however, this is a big liability sitting on the balance sheet of the company. So, question in front of us, should we invest in this company? If you see the numbers, particularly the profit, despite the fact that the company has done some accounting jugglery to create profit, the company's financial performance measured in terms of profit, PBT, PAT, and the TCI, total comprehensive income, as well as cash flow from operations, all are negative. Besides that, there is a huge receivable sitting on the company's balance sheet. So the numbers are not very encouraging. But if you see the narrative of the company, the industry, the technology that the company is investing in, the purchase behavior, the payment behavior of Indians is definitely giving us a positive signal about this company. So, but still, to invest or not to invest is a personal decision. Before you invest, observe but more minutely the numbers of the company and also understand the narratives of the company before you invest and subscribe for this IPO. Thank you very much.